Last week's close fundamentally altered the technical landscape. We are looking at an S&P 500 that dropped 2.64% on Friday alone, closing out at 7,383.74.
Right, which officially shattered that massive 9-week winning streak.
Exactly, it completely snapped, and the tech-heavy Nasdaq 100 took an even more severe hit. It plunged 4.77% on Friday, ending the week down 5% overall at 28,957.60.
Yeah, falling straight through that 29,000 handle.
And volatility just completely woke up from this months-long coma. The VIX spiked 37% to close at 21.51. So as we sit here this Sunday morning, June 7, 2026, prepping your trading screens for tomorrow morning's opening bell, the weekly time frame is screaming that the environment has violently shifted.
It's a totally different regime now.
It is. We're looking at a huge stack of institutional strategy briefs, macro event calendars, and technical damage reports. And the mission for this deep dive is to unpack this sudden, violent market whiplash and give you a clear-eyed game plan for navigating what is going to be a massive week ahead.
Because the footprint in the volume profile tells the real story here. I mean, this was not your routine, healthy market pullback.
No, definitely not.
Retail traders simply do not have the balance sheet to move markets this violently. If you look at the heavy block trading clustered right between the 7,380 and 7,420 zones on the S&P, that is a coordinated institutional distribution phase.
The big money allocators heading for the exits.
Exactly. The single biggest macro theme driving the market right now is this sudden realization that the Federal Reserve is pinned into a corner by sticky inflation.
Right.
And this massive AI-driven valuation boom we've been riding is finally and violently colliding with the reality of rising capital costs. Zooming out, the overarching theme for you to understand is a fundamental transition away from that blind buy the dip mentality.
We are firmly in a regime of extreme capital preservation right now. To me, looking at the data, the market action on Friday felt like driving 100 miles an hour down the highway for 9 straight weeks and just suddenly slamming the emergency brake.
That's a great way to put it.
But I have to push back a little, or at least ask the question. When I see drops like this, I usually assume it's retail investors panicking. Is that what happened here, or is there real heavy institutional weight behind the sell-off?
Oh, there is massive weight behind it. You don't erase $1 trillion of value in a matter of hours without major structural shifting.
Right, the semiconductor index.
Yeah, the SOX fell over 10% in a single session. That is a staggering $1 trillion in market cap wiped out.
Unbelievable.
And that kind of collateral destruction forces prime brokers and risk managers to spend their entire weekend recalculating margin requirements.
So to understand where the flow of funds is heading tomorrow morning, we first have to measure the exact blast radius of Friday, right? What was the actual catalyst that triggered these funds to hit the panic button?
The May non-farm payrolls report.
Right, the jobs data.
The U.S. economy added a blistering 172,000 jobs.
Which was, what, double the expectation?
More than double. The consensus estimate was only 85,000.
Okay, let's unpack this for a second, because 172,000 people getting hired sounds like fantastic news for the actual real-world economy.
On Main Street, yes.
Right, so why on earth is the stock market throwing an absolute tantrum over people getting jobs?
It's the classic good news is bad news paradox.
Right.
A red-hot labor market means consumers have the purchasing power to absorb higher prices, which keeps inflation sticky.
And the bond market sniffed that out immediately.
Instantly. The 10-year Treasury yield spiked 10 basis points on the news to close at 4.54%. Some desks had it at 4.55%. That completely revived fears of a hawkish, higher-for-longer Fed.
Because the market instantly realized that the thesis for a 2026 rate cut is just dead.
It's gone. Traders immediately flipped the script and began pricing in a 25 basis point rate hike by December.
Wow, from cuts to hikes in one morning.
Yeah.
And we need to highlight why those higher yields are instant kryptonite for tech stocks.
Yeah, walk us through the mechanics of that.
So high gross, high multiple tech companies, they're valued based on the present value of their future cash flows, right? When the risk-free rate of return, that 10-year Treasury yield spikes up to 4.55%, the discount rate applied to all those future earnings goes up exponentially.
Meaning those future dollars are worth less today.
Exactly. Those long-duration tech assets instantly undergo multiple compression. They are mathematically worth less today, even if their underlying business models are perfectly fine.
But reading through these institutional briefs, you can see the market was incredibly flammable long before that jobs report even hit the wire.
Yeah, the positioning was extreme.
Very extreme. Going into June, allocators were holding a 50% net overweight position in equities.
50%. That's the most bullish positioning we've seen since, what, January 2022?
Yep. And the concentration within that was heavily skewed. Being long semiconductors was a massively crowded trade sitting at 73% crowding.
So it's like 73% of the passengers were all crowded onto one side of a cruise ship, just staring at the AI view.
That's exactly what it was.
And all it took was one wave, that jobs report, to completely tip the boat. But there was also a hidden liquidity drain happening at the exact same time, wasn't there?
There was. Major liquidity was being quietly sucked out of the market all week. Alphabet executed a massive $85 billion equity raise.
Which instantly absorbs available capital.
Right. Then you had the desk chatter regarding Meta's rumored multi-billion-dollar secondary offering.
So that's cash leaving the ecosystem.
Exactly. But the real black hole for liquidity is the rebalancing ahead of next week's massive SpaceX IPO.
Oh, man. The SpaceX offering. They are targeting a valuation between $1.75 trillion and $1.8 trillion.
Right. And portfolio managers don't just have billions in unallocated cash sitting around to buy into an offering of that size.
They have to physically sell their existing liquid winners to free up the capital.
Right. And furthermore, bond buyers had aggressively front-run the jobs report. They were expecting weak data and bought heavily into the 10-year. When the data came in hot, they got instantly trapped underwater.
So you have maximum leverage, crowding on one side of the boat, and a total liquidity vacuum.
A total powder keg.
Give me some specific examples. Who fell out of the boat first when it tipped?
The specific tech dominoes fell hard. Broadcom tried to issue slightly conservative guidance on their custom AI chips.
And the market punished them.
Dropped 7.9% instantly. Then there were rumors of lower memory demand hurting NVIDIA's next-gen architecture. NVIDIA slid 6.2%.
And Micron.
Micron just cratered, down 13% in a single session.
Ouch. So the deck has been violently reshuffled. With this new reality of rising rates, we need to map out the calendar. What are the specific red folder events you need to be watching this week?
The calendar is packed. Wednesday brings the ultimate heavyweight May CPI hits at 8:30 a.m. Eastern.
And the consensus is bracing for a hot print there too, right?
Yeah, heavily elevated. They're looking for 4.2% year over year and up 0.5% month over month.
But it's not just a U.S. story. It's a synchronized global tightening panic.
Right. That same day, Wednesday, the Bank of Canada makes a rate decision while sitting in a technical recession.
And Thursday?
Thursday brings a highly probable 25 basis point rate hike from the European Central Bank to combat their 3.2% Eurozone inflation.
And hovering over all this central bank panic is the energy market. The closure of the Strait of Hormuz is keeping WTI crude elevated near $93 a barrel.
Which puts relentless pressure on inflation that central banks simply can't fix with rate hikes.
So, synthesizing all this global pressure, if I'm an investor looking at all these central banks panicking and yield spiking, where is the absolute most dangerous place for my money to be sitting right now?
Real estate. Specifically the real estate investment trusts, or REITs, tracked by ETFs like XLRE or IIY.
Interesting. Why is real estate the chopping block?
It's a dual threat. First, these REITs rely on massive portfolios of debt that constantly need to be refinanced.
Ah, the refinancing wall.
Exactly. If the ECB hikes and U.S. CPI runs hot on Wednesday, forcing Treasury yields even higher, the cost of capital for these property portfolios just explodes.
It totally crushes their cash flow.
Right. But there's also the yield competition threat. Allocators usually hold REITs for the dividend.
But if the risk-free rate on a Treasury bond is marching toward 4.6%.
Exactly. Why take on the leverage and default risk of commercial real estate when you can get a risk-free government yield nearly that high? Dividend-paying real estate completely loses its appeal.
So the strategy briefs are advising what?
Pivoting heavily to cash or energy until the bond market stabilizes.
Got it. Okay, so knowing all these massive macro risks, we finally need to turn to the technical map. Resetting the deck for tomorrow morning, what are the specific numbers you need on your screen, and how could this week break them?
Well, short-term trends are clearly broken, but the broader structural picture shows the 50-day and 200-day moving averages remain intact for now.
But there's a firm line in the sand.
The ultimate line in the sand is the S&P 500 at 7,360.
7,360.
Right. If that breaks and sustains below it, there is a technical trapdoor straight down to 7,205.
Wow, that's a steep drop. And what about the Nasdaq?
The Nasdaq 100 absolutely must reclaim 29,370 to stop the bleeding. And honestly, the most important ticker on your screen tomorrow is the 10-year yield.
It cannot break that recent high.
It cannot break 4.67%. If it does, tech multiples will contract significantly further.
Which brings us to the two pain trades the desks are mapping out for this week. The path of least resistance that inflicts maximum financial misery.
Yes.
The first is the downside long squeeze. With allocators still 50% overweight equities, a break below the S&P 70300 level would trigger systematic margin calls.
A cascading deleveraging event.
Exactly. Funds forced to liquidate simultaneously. But I want to stop on the second pain trade, the upside bear trap. Wait, after all this doom and gloom, you're telling me there's a scenario where the market violently rips upward this week and crushes the bears. How does that even happen?
It happens because the market is a tightly coiled spring right now. When the Nasdaq dropped so hard last week, it invited very late-stage short positioning.
The momentum bears piled in at the absolute bottom.
Right, so they are highly vulnerable. And the catalysts are right there on the calendar. Apple's WWDC kicks off tomorrow.
Oh, right.
If Apple steps on stage and delivers a major, unexpected AI breakthrough that shifts the hardware upgrade cycle, it could inject a massive bid right back into tech.
Or if Wednesday's CPI prints cool.
Exactly. Say core CPI comes in at 0.2% or lower. The institutional dip buyers sitting on all that cash would aggressively defend that 7,300 S&P pivot.
And all those momentum bears who shorted Friday's drop would be instantly trapped underwater.
Sparking a massive short covering rally that squeezes them out.
Wow. Okay, so summarizing the core takeaway for your game plan tomorrow morning, the easy momentum trade is broken. The RSI has been violently flushed out of overbought territory into this totally volatile no man's land.
You have to play defense.
Right. For now, it's about holding higher cash allocations, watching that 10-year yield to see if it stabilizes at 4.55%, and fiercely respecting that S&P 7,360 pivot point.
The bigger picture to consider, though, and this is a thought to just mull over as you watch the tape this week, revolves around this crazy structural tension.
Yeah, lay it out.
If a booming labor market is genuinely terrible news for stocks, and high inflation is forcing the cost of capital to skyrocket, what happens when the billions of dollars currently hiding in cash suddenly realize something?
Realize what?
That the AI technological revolution, the massive infrastructure build-out, the data center expansion, is going to happen regardless of what the Federal Reserve does with the overnight rate.
Oh, wow. That's a massive point.
Right. So the question is, are we watching the start of a structural crash driven by the end of the cheap money era? Or is this just the most expensive high-stakes game of macro musical chairs ever played, with institutions engineering a localized panic just to grab prime AI assets at a discount?
That is exactly the question you need to be asking yourself this week. Keep your eyes strictly on the data tomorrow morning, respect those technical lines, and trade the market in front of you. Thanks for joining us on this deep dive, and we'll be tracking the tape right alongside you.